The moment we all been waiting for. The Federal Reserve finally speaks today. The Federal Reserve Chairman speaks today, Jerome Powell. So we're going to sit back, we're going to listen to him, and we've seen stocks. Once he spoke, the Dow Jones went down about 500 points during the trading day after he spoke about interest rates, because the Federal Reserve, they controls interest rates. So we're going to listen to about a 7-minute clip of Jerome Powell talk, and I'm going to be giving you commentary along the way. So let me pull that up here in a second. But ladies and gentlemen, before I pull this up, if you haven't done so already, I know what time it is. You got to go ahead and make sure. Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of our ladies, you are now tuned into the Investor Show. As always, this is your gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we are going to jump straight into it. So what we're going to do today, ladies and gentlemen, as y'all can see here in my background, if you are catching this.
Good afternoon.
Can you slow down?
At the Federal.
Hold on, Jerome Powell. We're going to get to you. Calm down. We got you. All right. So here we go. So what we're going to do, I'm going to give you commentary. We're going to listen to the Federal Reserve speak today on interest rates, tapering, and the current condition of the economy. Let's roll that beautiful beam footage.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate.
So right here, they said they decided to keep the interest rates near zero, and they're saying that in this situation, interest rate will be appropriate in the future. This is why you're seeing everybody thinking they're going to raise interest rates in March. So let's go, keep going.
The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year.
Now, they just said that they talked about their tapering program. This is slowing down their purchases of assets, aka pumping money into the market, printing money, pumping into the market or whatever. The Federal Reserve tries to control the market to make the market go up over time. And now they're going and saying their policies, they're looking to shape them. Let's hear some more. As they talked about, he just said the economy expanded last year. Now, what happens? You start off in a trough, then you head up to an expansion. After an expansion is what? A peak. After the peak is a contraction or a recession, then you head back into the trough. That's the 4 market cycle. So he believes that last year we was in an expanding economy based on a GDP. Let's go, Jerome.
Reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy.
So he's speaking about if, pretty much common sense of if the pandemic slows down, we'll see the economy recover faster.
Remain uncertain. And we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
So what they're speaking about right here, they are saying he's speaking about unemployment because they're watching unemployment very much so, because unemployment is very key when you're looking at inflation. They don't want to raise interest rates because they always say they want to get maximum employment, maximum employment. So we're going to listen to this. So they're talking about the state of unemployment. How many people employed or unemployed? Let me see what y'all say in the comments. This is John Jar Binks. John Jar Binks. He said, "Oh, you're watching from today?" Yes, this is from today. That came on about a couple hours ago when the market was open. So he said, "Won't they need to raise rates over 7% to combat inflation?" I don't think they need to go up 7%. That's pretty crazy to go up 7%. Especially where we're at right now. We're not even at 1%, John Jar Binks. They're going to do what I remember they did back in 2010, 2011, 2012. They raised it in increments of 0.25. They did 0.25 weighted. They did 0.25 weighted. But as you're going to see, the Federal Reserve is saying he's not going to touch interest rates at all because they're going to slow down tapering to cool down the economy a little bit and to look at doing interest rates later on. What's going on, Banky Pound? What's going on, Bank? He's in the building. Glad to see you. He says, salute back to you, Bank. Unemployment is screwed. He's a liar. Hey. CPI is 7%. Yes, CPI is 7%. You're correct on that. The federal fund rate is less than 1%, right? So they're talking about, hey, why didn't they raise the interest rates? Let's hear what else you got to say.
Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated.
Now you see him, he just spoke on inflation. He didn't say it was 7%, but he says well above the goal of 2%. And we know this is above the goal of 2% because we read the CPI report, right? So he's talking about, when you listen to it, he's blaming it on a shortage, the supply chain shortage, not being able to meet demand. Let's get back to it.
Exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to...
Now, he just said wage growth has grown big time, right? Why is this important? You're seeing people at McDonald's are starting out at $17 an hour. When I was in high school 18, 19 years ago, McDonald's paid you $5 an hour. Now, the pay has quadrupled, and it's mostly done it right after the pandemic. The thing about it is when people make more money, they spend more money, increasing a demand for goods and services. When you have a demand for goods and services increase, and a supply chain shortage, he's saying this is pushing an upward pressure on inflation. Bank, what's going on? Bank said, trying to learn from the master. Okay, let's go. Let's listen. Go ahead, Mr. Powell.
Decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March.
So they're slowing the asset purchase.
In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal, the economy no longer needs sustained high levels of monetary policy support.
So he's saying, hey, we love the unemployment numbers, but we don't like the inflation. So this is why they're beginning their tapering, what we already know. Let's see how much they're going to do.
That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right. So there you go. That's Jerome Powell. He's the one he's talking about. He's the one that controls the federal interest rates, Federal Reserve interest rates, right? So when he says the Fed and our tools or whatever, these are the guys and girls that can print money. They can print money and push it into the economy. They're the ones that cut the stimulus checks. They're the ones that push down low interest rates, all of the good stuff like that, right? These are their quote unquote tools that they have where they're trying to pretty much they're manipulating the market to go up. The market falls too much. They got tools they can do to help push the market back up. So there you have it. So pretty much nothing too exciting. The market didn't react too funny. Mr. Jerome Powell is doing the best he can, and he's kind of conservative with what he says and does. Nothing too much exciting to see from Jerome Powell, but kind of reiterating what I've already known and kind of seen. But hey, it's good to hear what he's saying and what he's thinking. So right here, ladies and gentlemen, let me see what y'all saying in these comments before I get out of here today. What's going on, Joe? Joe J said Prince. He says, Prince, good show. Appreciate that. Hope we can touch on Apple and Meta upcoming earnings. I need you to drop a jewel. Okay, man. You know, that's what you need right there. Drop a jewel, right? But you know, we might do that. I got to see when their earnings come out. They might be about tomorrow. We are in the middle of earnings seasons. You know, now here comes tech. Tech is around the corner. You know, tech has been getting beat up very bad this year as people are rotating out of tech, out of the NASDAQ, and they're rotating into things like gold and oil because we're going into uncertain times. People are anticipating higher interest rates. And when interest rates go up, stocks cool off, mainly the ones you see in the NASDAQ, like the tech stocks and things like that. But yeah, we're gonna look into Meta and we're gonna look into Facebook. You know, since you requested it, Joe J, I definitely appreciate you for tuning in. But anyway, ladies and gentlemen, boys and girls, and children of all ages, I wanted y'all to sit back and hear from the Federal Reserve, the people who are controlling the interest rates and the people who are in control of so many other things to influence the market. So I hope you guys and girls got something out of it. Let me see somebody on Twitch. I don't know what you said just now. I don't know what that is and what you said, but thank you for tuning in. But if you haven't done so already, ladies and gentlemen, boys and girls, make sure you check out the podcast. Make sure you check out the book series, Wesley Learns. Grab you an Investor Show mug. It is the only way to read financial reports. You read them so much better when you have the Investor Show mug available in the description box. All right. Bank, that's my guy right there, Banking Pound. He said, I rely on Prince for the breakdown, the bottom line. They only going to tell us what they want us to know. Good job, Prince. Salute. That is true. Many times I will hear these people talk, don't know what they're saying, don't know what they're speaking about. Hearing people talk about, oh, this is the CPI and inflation and the Fed fund rate and all this stuff like that. But that's why I put it up, place it up so you can hear, see what the Federal Reserve is looking to do. The Federal Reserve said, hey, it is appropriate. They are looking to raise interest rates, something that we haven't done in years. And it's putting a lot of fear into the market. When a lot of fear is into the market, what they say, be greedy when others are fearful. Right now, there's a bunch of fear in the market. People are scared. They don't know what's going to happen. The Federal Reserve is coming up. We're in the middle of a pandemic. That's why you're seeing stocks fall off when it's uncertain and fear into the market. But watch out for gold and oil, which is making a comeback. And crypto is down like I don't know what. But anyway, boys and girls, ladies and gentlemen, hopefully y'all got something out of it. If y'all did, y'all hit that like, subscribe, comment, share button. Tell all your friends. Check us out on Instagram, Twitch, Facebook, YouTube. And into the next video, podcast, cartoon, or whatever else crazy y'all see me do around the globe. Peace. Be safe. I'm out. Thank you.